Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, taking credit. Now, we've talked a lot about the changes the Inflation Reduction Act has had on taxes and credits at the federal level, and we'll link to those episodes in the show notes. But today, we're taking a closer look at its impact on energy credits at the state level. So here to walk us through the topic is Tax Notes State Editor-in-Chief Audrey Pollitt. Audrey, welcome back to the podcast.
Thanks for having me, Dave.
So to begin with, could you give us a background on these credits?
Sure. The IRA created federal income tax credits to incentivize investment in clean energy projects. The credits' popularity is partly attributable to their transferability, meaning an entity that doesn't use all of a credit can sell that unused portion to a third-party purchaser. The seller typically uses the proceeds from that sale to finance eligible projects, and the purchaser has the economic benefit of buying a credit at a discount. And what's perhaps even better, the purchaser won't recognize gain on its use of the credit for federal income tax purposes. Sounds like a win-win situation, right? Here's the catch. Not all states follow this federal relief provision, and those states may try to treat the purchaser's use of the credit as a gain recognition event when computing state taxable income.
Now, I understand you recently did an interview about this topic. Who'd you talk to?
I spoke with Alysse McLoughlin and Quinn, partners at Jones Walker and Tax Notes State columnists.
And what did you talk about?
We talked about their April 15th article, A Trap for the Unwary Purchaser of an IRA Credit, which flagged this big potential pitfall for taxpayers buying energy credits at a discount in static conformity and decoupled states.
All right, let's go to that interview.
Katie, Alysse, thank you both so much for joining me today for a conversation about the hidden state tax issues that could arise from purchasing Inflation Reduction Act credits.
Thank you very much for having us on.
Thank you for having us.
Absolutely. We were initially scheduled to record this episode on April 25th. I was raring to go and so excited to speak with you both about your April 15th article. But then just before we were meant to meet, Treasury dropped the final regs on the transferability of certain energy credits, and it seemed only responsible to postpone our talk. Those regs, the final ones, were officially published April 30th, will be effective July 1st, and are responsible for giving me a minor heart attack. In broad strokes, and let's start with Katie, can you tell our listeners what happened in the time between the IRA's enactment and the issuance of the proposed and now finalized regs?
Sure. Thanks, Audrey, again for having us. So the Inflation Reduction Act was passed in 2022, and among other things, the act provided for we'll call them new and some improved federal tax credits. And these credits were designed to incentivize investment in renewable energy projects. And what we'll focus on today, and one of the major improvements to these credits were that the credits were made transferable. And what that means is that they can be sold by the party that generates the credits. And typically, these credits are sold at a discount, which provides the benefit for the purchaser of the credit. And Congress's goal in allowing transferability was to allow businesses that don't have sufficient federal taxable income to use the credits to nevertheless benefit from the credits by monetizing them through a sale. And one of kind of the spokes of this goal was that the proceeds of the credit sale could be used as financing for the developer. So this would allow for increased financing for developers of renewable energy projects, which would, just make these projects more prevalent. Now, so that's sort of the background of the Inflation Reduction Act. Now, let's talk about just general federal guidance regarding the use of a tax credit purchased at a discount. There is some federal guidance out there which predated the Inflation Reduction Act, and this concerns the use of a Massachusetts tax credit purchased at a discount. And what Chief Counsel says is that the purchaser of a tax credit at a discount recognizes gain on the use of that credit. And the gain would be based upon the purchase price and the actual credit amount. So the difference would be the gain. Now, the Inflation Reduction, there were proposed regulations implementing the Inflation Reduction Act. And those proposed regulations said that the purchaser of an IRA credit purchased at a discount, when that credit was used, there would be no gain recognition for the purchaser. Those regulations were finalized without change last month. So now the final rule is that the purchaser of an IRA credit at a discount does not recognize gain when it uses the credit.
So that's the federal treatment. What happens at the state level?
at the state level, I think we need to take a step back and we understand at the state level, when states impose their income taxes, it's generally based on federal taxable income with certain adjustments. So you would, for most states, if they are using the federal taxable income as a starting point, then because there is no gain that is being taxed at the federal level, there will also be no gain taxed at the state level. The problem comes in how the states actually adapt to the federal taxable income base. And some states, they have rolling conformity. So any change that happens at the federal level automatically impacts the state base also, unless the state specifically decides to diverge from that and to put in a modification. There are other states, however, where they adopt the code every year, every 2 years, every 3 years, every 4 years, or something. So in certain cases, they might not have adopted the provisions of the Inflation Reduction Act yet. And therefore, in those states, there could be a tax liability by purchasing a credit at a discount, and that would impact the amount that could be subject to tax in those states. For instance, Texas, I believe, has never conformed to the Internal Revenue Code since 2007. So there it could be in the tax base. California also has not conformed to the Inflation Reduction Act yet. So there also could be gain. And the reason there's gain is, if we go back to this, is at the federal level, when we talk about that the regulations said that there was, that there was no gain, they based that on the provisions of the Internal Revenue Code, Section 6418, which was adopted in the Inflation Act. And this one says that there's a transfer of a credit that the transferee taxpayer shall be treated as the taxpayer for purposes of the code with respect to such credit. And they said because of that provision, that's why they think there is no gain, and that's why they put that in, or no taxable gain, and that's why they put that in the regulations. They based it off of that. If a state is not following the Internal Revenue Code from the Inflation Reduction Act year, then they don't have that provision saying that the transferee taxpayer really steps into the shoes of the transferor taxpayer. And we think there is a fair chance that that can be taxable in those states.
Alysse, let's turn to two static conformity states with outsized energy markets. Texas, first in the nation in total electricity generation from renewable resources, and California, second nationwide and the top producer of electricity from solar energy.
So the issue then in those states, I know that there is an issue, as you said, because Texas and California have very large markets. But the issue is broader than that, because even if you have a taxpayer that is in California, if they buy a credit that is located in Oklahoma, let's say, it still goes into their tax base. So this impacts credits all over the country for taxpayers that are in, let's say, California or in Texas.
Katie, can you talk to us a bit about where taxpayers can find this information and how your practice monitors state conformity?
Yes. So, there are a number of things to look at in the various state tax laws to determine whether the non-gain recognition provisions of the IRA will apply at the state level. So the first thing, Alysse touched on this, is the conformity date. So if a state law conforms to the Internal Revenue Code as of a date before the Inflation Reduction Act in 2022, there's a potential issue. Secondly, some states will be rolling conformity or will conform, post 2022 to the IRC, but they'll decouple from all Inflation Reduction Act provisions or certain provisions. And this is very common when, federal tax acts are passed. Sometimes states will kind of cherry pick which provisions they do not want to conform to. So that's something that that you should look at. Then decoupling from just generally federal tax credit provisions. So we see this, California is a very good example of this. California, conforms to the Internal Revenue Code before the Inflation Reduction Act. So we have that issue as well. But California also says that in applying the Internal Revenue Code at the state level, provisions concerning federal tax credits do not apply. So what that means is, 6418, the provision allowing for transferability, and the regulations implementing that provision, providing for no gain recognition, arguably or explicitly do not apply in California. And then the last thing that you should look for is state modification. So this won't be in the sort of the IRC conformity sections of the tax law. These will be in the add back section. So if the state starts with federal taxable income, it provides for add backs to federal taxable income and then deductions from federal taxable income. So look for add backs for, amounts, quote unquote, excluded from federal income. And when you're looking at these provisions, the words really matter. So you have to make sure, if the statute says that they don't allow federal deductions, that's not as concerning when it comes to the Inflation Reduction Act, because the IRA gain non-recognition provisions really, they say that the gain never comes into federal taxable income. So it's not really a federal deduction. It's more of a federal exclusion. So if you see modifications like this, just make sure that you look at whether it's an add back for federal exclusions, federal deductions, federal exemptions. And then you probably also want to look at the case law in the state. How are the courts kind of interpreting these add backs?
Right. And is there any kind of case law in the state dealing with transfer of tax credits in general? Also, one interesting thing, I think, Katie, what you said about California is California says, we ignore any provisions talking about federal tax credits. So even if they adopt the kind of go up to Inflation Reduction Act years, the question is whether they will even look at this section 6418 and talk about whether there is the transfer of a credit as, stepping into the shoes of the taxpayer and making this a non-event, because they don't look at any credit provisions in the code. However, they also then, you might be able to say, there really is no transfer that occurs and therefore there's no gain. So California's rules, I think, are just very confusing and kind of very open as to what the real answer will be in California.
Well, Alysse, that sounds like a bit in your article where y'all talked about arguments against taxing this type of gain. Would you mind expanding on those arguments?
Yeah, sure, I will do that. And I know we had mentioned before how, for instance, California and Texas, two of the states that don't conform, have some of the biggest market for these types of facilities for solar projects and wind projects and other things that are out there. And in general, we would think that states should be on board with encouraging these types of investments, just like the federal government is doing. We all think, are aware that global warming's there and just trying to get some types of energy sources that are kind of less damaging to the environment and less damaging to the world. So we think that's important, especially in today's age where there's such more of a use for energy. Even if we look at AI and Bitcoin mining, there's a much larger use of electricity than there used to be. It seems like the use for electricity just grows and grows and grows. So there is more of a need for these renewable energy resources. So we think that all states should really be on board with this. And this is something where states should be trying to coordinate with the federal government. And that's especially, like we said, in Texas and California, where they have such a large market for this. And, they are so invested in these types of projects. That's something that we think, just as a policy perspective, they should be on board with.
Other than taxnotes.com, where can our listeners find you online for the latest on next steps and future developments?
You can find me and Katie at McLoughlin at joneswalker.com or Quinn at joneswalker.com. Or even if you just go to the Jones Walker Law Firm website, you can find us there. And we do have a blog that we put out with updates that will address some of, any kind of state tax developments that arise in this area.
Fantastic. Katie, Alysse, thank you both so much for joining us.
Thank you.
Thank you for having us.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now is Acquisitions and Engagement Editor-in-Chief, Paige Jones. Paige, what will you have for us?
Thanks, Dave. In Tax Notes Federal, Michael Spyro examines how Subchapter K's approach to holding periods, when combined with the many ambiguities surrounding goodwill, can lead to anomalous results. John Gamino and James Hamill examine the AICPA's revised standards for tax services. In Tax Note State, 3 Evershed Sutherland practitioners question if state conformity to federal R&E deductions is unconstitutional. Tram Lee and Connie Zorink examine business taxpayer challenges in complying with local tax authorities. In Tax Notes International, 5 Sanchez Devaney practitioners explain the difficulty faced by companies doing business in Mexico from the uncertainty of whether VAT is withheld on specific sales. Paolo Tognolo and Riccardo Mezzi examine enterprise task risk management approaches in Italy. And finally, in featured analysis, Marie Sapiri reviews recent IRS guidance on the domestic content requirements for the Clean Energy Bonus Credit.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at TaxNotes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, showrunner and audio engineer Jordan Parrish, and audio engineer Peyton Rhodes.